Hello, my name is Michael Glass from emini-trading-coach.com, and we're going to start off with our disclosures, which basically say that any investment decision you make is solely your own responsibility. You should trade at your own risk because there is certainly a substantial risk of loss of money, and you need to determine whether or not whatever investment vehicle you choose is suitable for your trading style. So we're going to talk about our futures technical analysis trading plans for October 23rd. When we look back at what were the key events of the past week, we can see that our three major indexes, the Dow Jones, the Nasdaq, and S&P, all rose this week. We are up for the year. Some of the key events that happened last week is that our Dow Jones did stay above the psychological 11,000 range. All 10 of our major sectors rose for the week. Earnings continue to be in play so far. That in the past week, we had 88% of the companies beat their earnings estimates, 62% beat their revenues last week. The majority of the financial earning companies were good. Citigroup, Goldman Sachs, Bank of America all beat their earning estimates. The only one to miss out was Morgan Stanley. Morgan Stanley did follow behind. Apple also had all-time high earning results. However, the reaction was trade the news. And on the economic front, there wasn't much going on. Jobless claims did fall on Thursday just a little bit. And the dollar had a very volatile week, especially as we head into this weekend of the G20 meetings. Now we will look at what's coming up in the week leading into Halloween. We have some more earnings companies. We have U.S. Steel, Visa, and Microsoft. Not sure if we're going to get a big move out of any of those. Possibly Visa, because Visa could say something about the consumer. As far as economic events, the big thing we have is GDP. And we also have Michigan sentiment. And on Tuesday, we have consumer confidence. Those can move the market. Those are some 10 o'clock news that can definitely drive the market. So when we look at our key technical analysis points, we want to look at resistance at the April swing high, April 2009 swing high, and we also have the 200 simple moving average on a weekly chart. As far as support, we've got the previous consolidation rate around 11/30ths, and we also have the 10 and the 20 exponential moving average as support range. And I put down here as a point of interest is the May 12th swing high, because now we are just fractionally above it, so what was resistance may now become support. So let's pull up the charts and take a look. So right here we have the S&P 500 as a daily chart, and I'm just going to briefly talk about the lines before I make this a little bit bigger so everybody can see. We talked about this last week, this yellow dash line, that is our April 2009 swing high. Our blue dash line here, that is our May 12th swing high. This red dash line, if you take a look, I will blow up just a little bit, you can see that every time we came up to this line, we fell down. And then in September, we stayed above it, so that became support. So that's what we were talking about before. We have our downtrend line, and then we have our 10 and our 20 moving average. So those, when I say about our key resistance, of course, our April swing high is our key resistance, and now our May 12th point of interest, will it hold up as support, or will we fall back down to our moving averages? And you come down here and look at our indicators, you can see that last week we were overbought. Our Tuesday down day, our down day here on Tuesday, allowed us to come out of the overbought range, and of course you can see we immediately went right back up. So once again we're back to this overbought range. So we may consolidate here, because what's going to be our catalyst? Consumer confidence could be a catalyst. Maybe GDP will be a catalyst. We don't really have any big earnings. We all know how dry September, the end of September, beginning of October was, as we were waiting for earnings to kick off. So it should be interesting here. Now the other thing you can do, and is draw an uptrend line here and see if we get a break there. So let me grab my line here, trend line. We take our low here and drag it up, and it's kind of matching up with that 20 moving average. So if we break that, we certainly have the potential to come down and test our previous resistance line. So that's definitely something to watch. Now, when I switch over to the monthly charts, and we'll blow it up a little bit. You can see our monthly indicators are saying that we still have more up room to go. They are not overbought. They're kind of in the middle. And you can see the same thing, resistance of the May 12th high. There's our April swing high. So they're saying we have room to go. We're staying above the 200, staying above the 50-moving average. All of that is bullish. Now, the other thing we talked about, our key resistance, is our weekly chart. And let's blow this up. And this orange line right here, this orange line, let me switch off the trend line, get back to our pointer. This orange line here is the 200 moving average, simple moving average on a weekly chart. And as we're in an uptrend for a year, March 2009 to April 2010, where do we die? At this 200 moving average on a weekly chart. And take a look at where we're at right now. So I think there'll be a huge psychological boost if we break that. Certainly we'll head up to the April high. However, will this once again prove resistance and send us down? Now, it sent us down to air-kissed our uptrend line from March of 2009. Will we come back down again? So those are some key things to watch. So as we go to the educational portion of our video, we're using the book Trade Your Way to Financial Freedom. We're on a chapter talking about how to select a trading concept that works for you. And the first concept he's presenting is Tom Basso and basically trend following. We all know trend following, the trend is your friend until it ends. And when you really think about it, you know, any trade that you're in, minus credit spreads, if you're in a directional trade, you need there to be a trend in order to make money. You need to either, if you're in a long, you need to go up. If you're in a short, you need it to go down. And so for trend traders, it's basically to identify a trend, and then you follow that trend. And that's where you kind of bring in that multi-time frame analysis. We've talked about this over and over again. The longer time frame sets the trend. The shorter time frame gives you the triggers for the trade. If we're in a long-term uptrend and the shorter time frame is in a downtrend, when it turns back up to an uptrend, now we have agreement of our shorter and longer time frame trend agreement. We can now enter the trend. Some of the advantages is that you'll never miss a major move because you're always in this trade, and because you're in a trade longer terms, you have lower commissions because you're not getting in and out. Some disadvantages of trend following is that, you know, your indicators can't tell you whether or not this is just a minor pullback or whether or not this is a major shift, a la October 2008. Does following the trend still work? Sure. And is it suitable for everybody? Basically, it's a simple strategy to learn. Most systems are actually kind of based off of it in one way or another, so it's certainly a route to consider. Resources. Of course, you can find us on YouTube, Facebook, and Twitter. We have some great free resources for you. Emini-Trading-Coach on YouTube, Emini-Trading-Coach on Facebook, Emini-Coach on Twitter. We have a great instructional video series. It has 3 parts to the video curriculum. First, we go over the basics of trading. Then we go over the components of a trading plan and how to work them into your style. And then we readdress the fact that all setups are equal, so we want to go over the trading setups again. We talk about them in the other parts of our video series. And then we talk about market internals and the routines, the habits of successful high probability traders. Our main focus, our name says it all. We're all about coaching. We're all about mentorships. And, you know, one of the hardest things people have to overcome to get into coaching is admitting that you're wrong. Well, you're not wrong. We've talked about this often. The greatest athletes in the world all have coaches. There's nothing wrong. It's not a challenge to your manhood. It's not about being right or wrong. It's about helping you define goals and steps to achieve that goal, and more importantly, putting you in the right system, in the right market, so that you can be a successful trader. We got a great relationship with Global Futures. You can get 20 free contracts for our e-mini traders. And again, when we're talking about coaching, we're talking about being prepared to trade. I'm a firm believer in virtual trading, paper trading with the right mental application. And so Lou Holtz said the pressure is having to deal with something you haven't prepared for. That's why you have a preseason in sports. That's why they're out there practicing before the game. You had to practice so that you can continue to adjust to the current market conditions. Because in the end, it doesn't really matter if you purchase a new trading system, if you find this new technical indicator, or you're following some guru's high probability trading setup, if you don't have the psychological capital to pull the trigger. And that's what we at emini-trading-coach are all about, helping you pull the trigger and identify high probability trades. Thanks, guys, and I'll see you next week.